Masterclass with super investors. In this video, we're going to learn from Kenneth Andrade. His key mantra is to focus on the balance sheet and wait for the economic cycle to turn for the company. So what does he mean by focus on the balance sheet? We'll learn a lot. But let's look at what he did. In his career, he started as a journalist and he worked at the Capital Market magazine, and he has exposure into stock markets from his father, who was an NRI, and due to that they got preferential IPOs allotment, meaning they got IPOs shares in India at a preferential basis. So he actually knew a lot of that all the way from his father's side. Then he went into becoming an analyst and at Samir Doshi Associates, and then Apple Asset Management, and then ShareCon most notably. And then now he's CEO at Old Bridge. Down cycle has taught him a lot of humility, was key learning. So protecting the downside is more important, and so much more important than catching the upside, which is a good learning. His style is to focus on the balance sheet. What does it mean? He's looking for companies that are improving the capital efficiency. By that, return on capital, right? Are you improving the return on capital that is employed? Then he likes that companies. And once he's identified those companies, he's found them for cheap valuation, he's going to wait for the economic cycle to deliver the returns. He's patiently going to wait and ride that wave up. He thinks about growth in earnings with very little importance, because he thinks about them as future oriented numbers, whereas balance sheet is current numbers. So if you see the difference, you cannot compare the future numbers, which is earnings potential, with current numbers, which is balance sheet. So he completely ignores the futures, or discounts it is a better way, for the earnings. And so he's looking for companies which have good balance sheet, meaning whose working capital is improving, whose cost of capital is decreasing, and who has larger staying in the game power, or larger longevity, right? Who can be more competitive over a long period of time. That's what he's looking at. And those companies, ideally, if they have market dominance, meaning who are actually executing really well, and due to which they have gotten the dominance in the market, who have a huge market share already and are gaining share, who's growing reasonable price to earnings, you're not paying too much, low capital expenditure, and high cash generation. So that's again high, strong balance sheet companies. He's looking for those companies. And he says that you don't need to gain market share because you always need to add capacity, which was a good learning, because he says, hey, even customers move to strong players, and that's how you get business consolidation and more market share. And at the bottom of the cycle, there are few companies making profits, and so he has a way to detect the bottom, and he says the entire sector, the entire industry, there will be very few companies who are making profit. So that is ideally the bottom. So you've seen a lot of investors who've given us different tips as to when they can detect a peak, when they can detect the bottom, and when they enter and when they exit, right? And so that's one way. And also he says higher leverage happens at the very top, at the bull market, right? So the market's at the topping out when there's a lot of leverage, and it's bottoming down. It's bottoming if there are very few companies making profit, because at the end of it, you need those products. Those are essential products. So those companies have to either increase the price or become profitable, right? So the way you find out which companies are actually having more power is to find out where is the value chain of the company, and what parts of that value chain are making the money. And so you'd have to deeply understand the product. So that is key critical insight, which is you can only understand the company if you understand its value chain. He says management cannot beat the economic cycle. So there's always this question that's been asked: is management more important, business cycle more important, economics of the business model more important? And he also discounts a lot of annual report because he says it's a lot of stuff, lots of volumes. He reads few parts. I think it's management, MD&A section, discussions, and also focuses purely on the numbers, the financial parts. So a lot of other parts he just ignores. And he's looking for shrinking balance sheet. By that, what does it mean? He's looking for companies where the debt is being reduced constantly by the free cash flow that's being generated by the business. And so that I think is key. Remember, his key mantra is strong balance sheet companies. And so he's looking for free cash flows. He's looking for those companies where there is lack of future distress. There is less distress in the future because of free cash flow generated by the company. And so at the end of it, capital efficiency for him is which companies are generating capital in the most efficient way, right? And so return on equity, return on capital employed, those are key metrics that are important to him. He's also said that balance sheet again is WYSIWYG, which in computer science is what you see is what you get. But is balance sheet is that it is the past and a current point view of where the company is. But if you look at growth and revenue projections, and if you start to do DCFs and all of that, that is WYSIWYG, right? It's what you believe is what you get, right? So it's not WYSIWYG, but it's WYSIWYG. So that was pretty interesting analogy that he used. And he really values financial statements much more than the annual reports. Look for companies, look for the margins that they have, look for profitability. And if you see a lot of variations, investigate further, which was a good insight. And he says, figure out a price that you want to buy a company at, and you'll always get that price. So just wait for it. That's the patience that you'd have to deliver. So if you want to buy, let's say, HDFC Bank at 1,400, we can buy it at 1,400. If you want to buy it at 1,000 rupees, you can buy it at 1,000. There was many times in the last 2 years when it did reach that valuation. Similarly, whatever the company, whatever the price, it will come there, but you'll have to wait. And he says India has been a hope trade for way too long, and I hope it changes. So he says there are lots of ifs and buts. If this happens, then this will happen. He doesn't understand why the country is stuck, but he sees a lot of potential, a lot of large market that India has to use. So there's a lot of potential that he sees. So really bullish. He also shared a really good example. He said how in the real estate, the city center, which is the most prime location, that's where the bubble starts or the boom starts. The property prices first increase there, and then eventually it spreads out to the periphery because less and less people are at the periphery. Similarly, he sees that the boom starts in quality stocks first, like the best of the companies will do really well. So you see high P's, and then eventually you see even like the smallest cap, like which are not even around, they also start to increase. So when you start to see periphery stocks or periphery real estate, going through this massive re-rating, that's the time it's peaking out. So following your investment natural style is pretty critical, and a lot of super investors have taught us this. And he also says that a lot of investors make money in only their third cycle. Really good point. A lot of them in the first cycle of the bull phase, they don't really make money. They make a lot of mistakes. Second phase, they also make a lot of mistakes, and hopefully if they learn from the first two cycles, then they can actually make money in the third cycle. And you don't need to be in all the parties. That was a key insight. He says, just be in the party that you like and make money there, right? And repeat those instances. And remember WYSIWYG. That was his key takeaway. What you see is what you get, and you see that in the balance sheet.